All right, so your value is at 900,000 on your home, which means that at an 80%, it would be a $720,000 loan to value, 80% in Texas. Okay, this would be a second position, not a first.
Okay.
The reason that I'm thinking a second position just right now is because you have the lower credit score. You can get into a second position under 700 sometimes. So that's something you could call the bank and ask them. Have you tried that yet?
No, I haven't. We were
Okay.
going for gold to start
Okay.
with.
Yeah. So with your $521,000 loan that you currently have, that's going to leave you quite a bit of money to be able to pay off your other debt, which is going to do nothing but scream you through your debt removal. Okay. So we are at $199,000 now that is available for you to use. Now, this would only need to be done for just a little while because you're trying to get your credit scores up, which they will move up quickly once you get this debt worked down, and it's going to work down pretty fast.
Okay.
So let's show you this option of using a second position. And let's imagine that we pay off your high payments, which would be your Jeep, Ram, and Hyundai. Okay, and that totals $139,821. So $139,821, and you have a payment of totaling about $3,055. So this would go into your line, pay this off, gaining the $3,000 in cash flow. Okay.
Yep.
Now, when you have gained that cash flow, you could go ahead and pay off the little bit of credit cards that you have too, because you don't have much. So at this point, all of your income would start going in here. Every time you get paid weekly, bi-weekly, monthly, it doesn't matter. The money would go into this line. Then all of your expenses would come back out. So you have debt payments of $81.60 minus the $3,055 that you no longer have. So now you have $51.05 in debt payments. And then you're going to have your regular living expenses, which you're showing at $5,051. Now that's with $1,200 in savings, so you'd have to determine whether or not you were going to keep doing that while you're going through your elimination. But let's say you do, so $5,051 for expenses. So you're at $134,177. Then we're going to take that times what the rate on Texas is. They're ranging, so a lot of people I hear there are getting promotions of like 6.99% for the first 6 months or the first year, and then it'll pop up to about an 8%. But the average nationwide is about 9.25, so I'm going to just use that. So you're at about $1,000 interest. So 135,177. I'm probably getting off of the camera. 135,177. Your income would go in again for month 2. You're at 119,377. So what does it mean while we keep doing this way? So this would be paid off in 24 more months if you were looking at it like that. So 24, 25, 26 months actually to pay off the 139 here. I don't know how long you have left on your cars, but that's about 2 years of payments doing it that way to a complete payoff. But of course, we never get to a complete payoff because we're always using the line of credit. You know, probably about 6 months down the road, you would be able to have the 20% back into this line for sure that you could then use as the 20% that you need to put into the first lien. Does that make sense?
It does make sense.
Okay.
What does not make sense is what the ramifications are of having this in the second position to start. So that's
okay. There are no ramifications except if something were to happen in the first 6 months, for example, that the market crashed, they could freeze the HELOC, which means that this would turn back into a loan. Okay. That's the worst case scenario for a HELOC, is that they'll freeze the funds where you can't take out anymore and they turn the balance you have back into a loan. So that's basically what you've got right now. You're just throwing it into a line so you can work it down. In the event something happens while you're working it down, they freeze it so you have a lower balance that they're going to put back into a loan.
And then,
Okay.
do they normally keep that crazy APR when they do that?
This right here is so much cheaper than what you're paying on the loans right now.
Yes,
Yeah.
it is.
Right. So probably not. They would probably, whatever the interest rate is at that time, they would transfer it into that because it's going back into an amortized loan. The chances of that happening are pretty good because we're in an unstable economy. But if you moved it into the first lien just as soon as you can, a freeze has never occurred on a first lien because it's in the actual position of the mortgage.
I see.
Okay. So the first lien is a little bit safer as
Yeah.
far as if the market drops or whatever. You have another option without moving into a line of credit right now. You could go with the MoneyMax automated system. That literally eliminates interest. So with all of the interest that you're paying right now on the debt from the credit cards to your home, so your 4.85% is almost 100% of interest that you're paying on the home.
Yeah.
You've already paid 3 years of it, so you've paid mostly interest up to this point. So what the automated system does is it brings all of the amortized rates, everything you've got from, the high of 27 or 14, on the low one you've got is your home, and that's not low. All of that comes down to 2% approximately. So that is how they wipe out debt faster than what I'm showing you here. Because now your income is focusing on principal amounts and only 2% interest.
And that's just because the AI in that system is paying
Yes.
down to principal?
The algorithm knows when to put a payment on a debt that is going to actually clear debt instead of pay interest. So if you're hitting it right on the date that it tells you to make the payment, then you have no choice but to get out of debt. That's a guaranteed product. So are you paid weekly or biweekly, monthly?
Biweekly.
Okay, so not a doubt in my mind that you're probably going to go in there and they're going to tell you, I would say you're going to get a guaranteed 8-year payoff.
Okay.
Because you have quite a bit of debt. You're about 760,000. Yeah, I'd say that would be an easy 8-year payoff. So with using a first lien or an all-in-one that you could move into eventually with your mortgage, you're talking about probably a 10 or 11-year payoff, maybe.
Okay.
It'd be under 12 years. The system works faster just because it's eliminating debt. So, you have the choice of doing either or this even. It just depends on what area you want to move into. Now, this being $1,000 of interest at your very beginning, of course, is going to come down as the balance comes down. So that means that in the first 3 months, you would have paid interest into what you had into the automated system because it runs about the same. So, but once that's a one-in buy-in, once that's done, you can use and reuse that as many times as you want throughout your life with free coaching. This, you're going to keep paying interest, but it works too. And you can continually revolve it, and you can use both at the same time, or you can use the first lien HELOC at the same time. So it just, your strategy depends on how fast you want to move through debt and how far you're willing to go to get there quickly.